In this video, I am going to be looking at 3 stocks that are trading near their 52-week lows right now. Are they undervalued opportunities or still not worth buying? Let's find out. Stock number 1 is Starbucks, which is down 16% in the past year and is currently trading at $81 per share. It has a market cap of $93 billion and they pay a nice dividend of a yield of 2.9%. Starbucks revenue was growing very nicely from 2015 all the way to 2023, from $19 billion to $35 billion. However, as you can see, in the last couple of years, their revenue has stayed at this level. The same with net income, it was growing very nicely until 2023. However, since then, it has seen a big decrease from $4 billion to $2.6 billion currently, which is what they were doing 10 years ago. And the exact same happened with free cash flow, obviously excluding 2020, which we know was a fluke year, and 2018, clearly a fluke year. It has been the same over the past 10 years, as it is currently $2.2 billion. And Starbucks margins have also suffered in the past couple of years. As you can see, again with the exception of 2020, they used to do around 14%, but in the last couple of years, this has decreased all the way down to 7%. However, if we take a look at the financial forecast, analysts are expecting them to recover nicely. As far as revenue, they are expected to go from $37 billion all the way to $60 billion in 2030. And as far as profit and EPS, they are expected to make $6.86 per share again in 2030. So very nice growth in terms of EPS and revenue expected. In order to calculate the intrinsic value for Starbucks, I use my discounted cash flow model and net income model, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value for Starbucks, according to my low assumptions, is $37 per share, middle $57, and high $85 per share. And the stock is currently trading at $81 per share. This also means that if my low assumptions occur, you're going to make a negative 3.3% annual return on your money, middle positive 4%, and high positive 10.8%. And these returns include the dividend because dividend comes from free cash flow and net income, so we cannot double count them. So according to my assumptions, it seems that the company is still a bit expensive. And I think they are fair as I have the company growing between 4 and 8% annually for the next 7 years in terms of revenue, which is what analysts have them doing, averaging a profit margin and free cash flow margin between 7 and 11%, and I assigned a P/E price to free cash flow at the end of the 7 years of 16, 18, and 20. In terms of their balance sheet, Starbucks has a decent balance sheet as they have $4.5 billion in cash and $27.9 billion in debt. A lot of this debt comes from leases, and therefore it is not a lot for a company that has a market cap of $93 billion. As far as the risks of investing in Starbucks, number 1, I have a decrease in same-store sales. Starbucks has had multiple quarters where same-store sales have declined, especially in North America. Number 2 is the margin pressures from rising costs. We have seen that their margins have been decreasing. This is mainly due to labor, real estate, wages, supply chain expenses, and commodity inputs, such as coffee beans. And number 3 is the competitive pressure. There are many competitors: local coffee shops, fast food chains, to-go beverage spots, and premium cafes. In some markets, Starbucks is losing ground to cheaper or more locally resonant alternatives. The last risk that I want to mention is actually their dividend. If we take a look at the dividend information, their dividend yield, as we have seen, is 2.9%. However, the payout ratio is 105%. The payout ratio is what percentage of their net income and free cash flow goes to pay the dividend. So if you invest in Starbucks because of their dividend, be careful because it might get cut. And in conclusion, I don't think Starbucks is cheap enough in order for me to buy right now. I would probably be interested in this company at around $60 per share. Stock number 2 is Target, which is down 38% in the past year. It has a market cap of $40 billion and it pays a very good dividend of a yield of 5.07%. It currently has a P/E ratio of 10, so it seems cheap, but let's find out more in depth. Starting with their revenue, it was growing very nicely until 2023, but since then it has decreased from $109 billion to $105 currently. Their net income has stayed between $2 and $3 billion over the past decade, with the exception of 2022, which is a fluke year. And Target has very slim margins, as they have been between 2 and 4% over the past decade. And analysts are expecting very little revenue growth over the next 5 years, as they are expected to go from $106 billion to $117 billion in 2030. And EPS is also expected to grow, but very little, and they are expected to reach $10.47 per share in 2030. As far as the intrinsic value, according to my low assumptions, it is $58 per share, according to my middle, $107 per share, and according to my high, $173 per share. The stock is currently trading at $89 per share, and this means that if my low assumptions occur, you're going to get a positive 2.4% annual return on your money, middle 30.5%, and high 23.5%. So huge returns according to my high assumptions and very nice returns according to my middle. And I think my assumptions are quite conservative, as I have the company growing revenue between 1 and 5% over the next 7 years, averaging a profit margin and free cash flow margin between 2 and 4%, and I assigned a P/N price to free cash flow of 14, 16, and 18. As far as the dividend, contrary to Starbucks, their dividend is a lot safer because although the dividend yield is higher at 5%, the payout ratio is only 52%, so they can clearly afford to pay this dividend. However, one risk to consider when investing in Target is the balance sheet, as they have $4 billion in cash, but they have $20 billion in debt, which is quite some debt for a company that has a market cap of $40 billion. And therefore, the main two risks that I found in investing in Target are number one, the slow growth, which is that management projects a low single-digit decline in sales for fiscal 2025, and this is a very slow growth company. And number two, as I have already said, the debt and interest expense, because Target's long-term debt is increasing, which raises interest payments and puts pressure on cash flow during times of weak sales. So for these reasons, I am not going to add Target to my portfolio yet. I believe it is just a little bit discounted, and I prefer to invest in companies that I believe are heavily discounted, such as Alibaba, which I am up 105%, UNH 41%, or SoFi up to 171% this year alone. And stock number 3 is Cava stock, which is down 47% in the past year. This is a smaller company, $7 billion in market cap. And analysts have them as a buy and a lot of upside, as their price target is $101 per share, which means 58% upside. This company has grown very rapidly, as their revenue has grown from $500 million to $1 billion in just the past 5 years. Their net income has also grown very fast, going from negative $37 million all the way to $140 positive million. Their free cash flow more or less the same, although it is less, and it is currently at $47 million, and this is something that I don't really like about this company. And analysts still have a lot of growth expected for this company, as their revenue is expected to grow from $1.2 billion to $2.4 billion in 5 years, and their EPS, although it is going to decrease this year, it is then going to increase to $1.60 per share in 2029. So still a lot of growth expected. And as you can see, regarding the intrinsic value, according to my low assumptions, the stock is worth $12 per share according to net income and $8 per share according to free cash flow. According to my middle assumptions, $30 per share and $24 per share. And according to my high, $60 per share and $51 per share. The difference here is because, as we have seen, their free cash flow is a bit lower than net income, so this is why I assumed a lower free cash flow margin than net income margin. So according to my assumptions, it seems that the stock is trading still expensive. And if you want to make your own assumptions, I'm going to leave a link in the description below to the spreadsheet. It is super simple to use, as I've done all the calculations in the background, so you only need to put the inputs that matter. Moreover, Cava has a great balance sheet, as they have $385 million in cash and they only have $433 million in debt. So basically no debt for a company that has a market cap of $7 billion. However, I found some risks in investing in this company, which are number one, weaker same-store sales and soft guidance. So in their Q2 earnings, same-store sales only rose by 2.1%, well below expectations of 6.5%, which forced the company to lower its full-year sales growth outlook from 6 to 8% to 4 to 6%. So this suggests traffic and consumer frequency are softening, which can hurt growth if the trend continues. And number two is the macroeconomic risks and consumer behavior. With economic uncertainty and tighter budgets, consumers may pull back on dining out or favor more value options over higher-priced fast casual meals, because Cava's meals are not cheap. So for these reasons, and because I believe the stock is not really cheap, I'm personally waiting for the stock to drop more in order to then evaluate the company. I hope you found this video valuable. Let me know which one of the three companies you are buying in the description below, and I'll see you in the next one.